Welcome back, Alpha Hunters. Today's video is going to be about the wheel strategy. I've had a lot of requests to do this, and there are a lot of videos and even channels out there completely built around doing the wheel strategy. And I feel like there's a lot of shortcomings in some of those videos as they don't fully cover some of the tips and tricks and things to stay away from that you can have too much risk exposure while doing the wheel. Okay, so I'm going to quickly run down the wheel. I'll give you some of my tips and tricks, and then we will look at some examples for how to maximize some reward potentials while running the wheel strategy. Okay, so most of us, we're going to start out by selling a put option because we're not going to have a stock position. Okay, so if you don't have a stock position, you're going to start out by selling a put option. And then once you get to expiration, if the option is not in the money, then you need to basically just repeat the process. You know, you just say, okay, if the option's not in the money, and you just repeat the option sell. So you sell the put option and you do the same thing again. Okay, so you kind of keep doing this little shorter wheel here until you get to the part where the option actually is in the money. And then what's going to happen is you're going to take on the stock position. Okay, and then once you take on the stock position, you turn that around and you just sell covered calls against the stock position you own. And then once you get to the expiration for the covered calls that you sold, if they are not in the money, well, then you repeat the option sell, okay? And then basically you just do this little wheel here until you get to the expiration of the covered call you sold. Then if it is in the money, then you will give up your stock position, okay? And then basically you just go back to selling the put option. You repeat the process all over again. So that is kind of how the wheel works. There's actually 3 wheels going on. There's the selling the put option and just repeating that until you get assigned shares. And then you turn that around, then you sell covered calls, and then you repeat that until your shares get called away. And then this whole thing, a whole process of being assigned shares from the put option to then selling the covered calls to then giving up the stock position. The process of that is also a wheel strategy. So that's why it is called the wheel strategy. It's a very effective long-term strategy. But there can be some downsides that you need to be careful of, okay? So let's talk about some tips and tricks to kind of keep us in line and our risk managed, okay? So we need to know and understand what kind of strategy this is. This is a cash flow generating strategy, okay? This is not a high-flying strategy. We're looking for massive returns. We're trying to build just our cash flow generating, and that way we can invest into other areas, whether it's back into this wheel strategy or potentially into other stock positions. Now, the kinds of stocks that we want to do this on, this is like the highest of quality stocks. There is very little concern of them ever going bankrupt, out of business, having downturns of demand or anything like that. You're going to want to stay away from high growth stocks and unproven stocks. And I'll show you why here a little bit later. But there is a potential that if you get assigned shares when the stock price has been rising greatly and then it pulls back 80 to 90% potentially in a bear market, you will then be down. It doesn't even matter how much cash you generated because you will have a potentially a larger hit on the stock value pullback. Okay, so we want to avoid those types of situations. So we're going to be looking for the highest theta or the highest time to gain that we can find in our option strategies, and the maximum theta is going to be at the money close to expiration option. So when you start out doing cash secured puts, you're going to want to start out at the money closest to expiration because that is where you can bring in the most cash. Now, when you do eventually get assigned shares, this is one of the top tips I have for you because I don't really see anybody talk about this or cover this in other wheel strategies, but you want to sell the same strike for your covered call as you did for your cash secured put. And the biggest reason why is it is possible to lose money on the wheel strategy if the stock drops far enough, maybe a rapid decline, maybe they missed earnings or they had bad outlook. But, that's fine. If you're doing a high quality stock, you should come back. But if you get assigned shares and then you turn around and sell a covered call at a lower strike price than what you took it in at, it is possible to lose money even though you collected the cash from the cash secured put and the covered call. So we will look at a little bit of that type of scenario here in just a couple minutes. But I just want you to be aware of that you do want to sell the same strike for your covered call as you did for your cash secured put. And if you change your mind on the stock, if you're doing this on the stock and maybe market sentiment is shifting, don't be afraid to close your stock position, okay? Usually what will happen is you will sell a cash secured put, and then it seems like the market's just shifting away from that stock, or you just don't want to do it on that stock anymore, and that's fine. Hopefully you're not going to sell it at a loss. If you got to take a little bit of a loss, just close it. Don't be afraid to risk manage if that's not where you want your capital to be anymore. So let's go ahead and go look at some examples and keep in mind some of these tips and tricks. Okay, so let's look at some examples. Now, I'm looking at a stock chart here for Colgate-Palmolive Company. The ticker symbol is CL. And what we want to understand is this is not a hugely volatile company. They very much kind of trend bottom left to top right, and it's not a hugely volatile company. So this is a really good one to potentially do the wheel strategy on, okay? Now, is there other companies out there that are more volatile? They have higher premiums on their options? Yeah, sure. But if we're looking to do that kind of strategy on, let's say, something that is a little bit more volatile, a little bit more high growth, high flyer, let's look at Peloton. So I know there were some people saying, oh yeah, just do cash secured puts on Peloton. And it's like, and I couldn't imagine being put shares up at like $130 or so, and now Peloton's all the way back down to 18. So when you get assigned shares, you don't want that capital to be at risk, because if you do decide to change your mind on the company, well, you don't want to have to close out. I mean, that's roughly a 100-point loss, potentially more, depends on what strike you were selling for the cash secured put. But this is the kind of stuff that you definitely want to avoid when doing the wheel strategy. You want to go with safe, secure stuff that's reliable, works. You don't want your capital that you are basically investing into the company, even though you're doing a cash secured put and you're not taking on the shares yet, you don't want that capital to be at risk if you wind up taking on shares. And that is the way I think about doing the wheel strategy. Even though I'm doing a cash secured put, to me, that cash is invested into the stock, because I'm willing to take on that investment, okay? So you definitely want to stay away from high growth stocks or stocks that are high flying. You want to be stocks that are a little bit more steady going. You know what their expectations are and those kinds of things, okay? So right now, CL is currently trading around 74 points, okay? So 74 and a half. Okay, so what I want to do is pull up the option chain for CL, and we can do some quick analytics and just kind of check out some things. So we're looking at the option chain for CL. We got calls on the left side, puts on the right side, and we have theta in this column. Okay, so that's theta, and then that's on the put side. And for the call side, we got theta in this column. Okay, so we got delta, gamma, theta, vega, and then same thing on the put side, delta, gamma, theta, vega. Okay, so we can see theta for the 74 strike put is roughly 15 cents. So we would gain 15 cents per day if we were to sell this option until expiration. Okay, so let's go look farther out. Let's go look at a 10 June option. That's about 5.5 weeks out at our current time period. So if we were looking to sell this one, we'd only be collecting 3 cents per day. Okay, so that just kind of tells you how much money you are going to be taking in per day or collecting per day as time value just goes by. Okay, so if time value just kind of goes by roughly at 14 cents per day or 15 cents per day, I know it's kind of moving a little bit, the market's open, then that's how much you're collecting. I would rather collect 15 cents per day rather than 3 cents per day. That is why I do usually sell the at the money, the put options, because if I'm willing to take on the shares, if I'm putting up the capital to potentially take on the shares, then why not get the most bang for my buck? Like even if the stock pulls back and gets under 74 points, and it pulls back to maybe 71, 72, well, that's fine. I was willing to own the shares anyway. I'll just turn around and sell the covered calls. I don't care if I get assigned the shares on a company like this. It doesn't deter me from, is the stock changing? I mean, I can see the stock chart. It looks pretty healthy on the long term. Do they have some drawbacks, maybe like over a couple months? Yeah, sure. Okay, they do. Every company does. But I'm not worried about my capital on the long term being at risk. I'll just turn around and I'll just sell covered calls. And if I get assigned shares at the 74 strike price, well, like I said earlier, you just turn around and sell the 74 strike price for the covered calls, right? Because you would have 100 shares. So then therefore you would sell the 74 strike price for the covered calls. And really that's kind of what I like to look for in companies like this. I like to look for companies that don't move around that much, and I can constantly sell the at the money strikes, whether it's puts or the call side. If I get assigned the shares, obviously I'll be selling the call side, but hopefully they kind of stay around and they don't fluctuate that much. That way you're constantly selling the at the money, because that's where you collect the most cash. Okay, and that's the whole point of a strategy like the wheel, is to collect the cash flow. And whether you roll that back into fronting that cash into more contracts for the stock, or if you use that into other stock positions, that's completely up to you. But you can definitely do that and just keep rolling it and compounding this. But that's how I run the wheel. Those are some tips and tricks for you. It's really good to just be as close to at the money and close to expiration as possible, because that's where you collect the most time value when you are selling options. Okay, I've seen some videos out there where they say, oh yeah, you want to go out like 2 months, and I'm like, well yeah, but you're only collecting like 2 cents a day, and I'm trying to collect like 10 to 15 cents a day. And it's like, if I take on the shares, I don't care. I can't do anything with my capital while I can sell a cash secured put, right? It's already fronted, well, like I bought the stock already. So why not collect the most cash I can? Okay. And like I said, do this on very, very high quality names, companies that you've definitely heard of, you definitely know or use their products. I would not do this on like high growth, new companies that are looking to take market share. These companies know where they stand. People buy their products on the regular and that kind of thing. That's what you're looking for. Like, they know their business. Now, if you want to know how much capital is required to put up for the wheel strategy, really a quick way you can do it is you can look at the stock price, and you can multiply the stock price by 100 and then multiply that by how many contracts you are looking to sell. But if you're looking to get a little bit more precise, you actually would want to figure out the strike price that you are wanting to sell. So say we'll take the 74 strike price. So we'll take 74 and then we will multiply that by 100. Right? And the reason why you multiply it by 100 is because each options contract you sell is for 100 shares. Okay? So if you're going to sell just one, in this case, it would be $7,400 that you would need to put up. If you were looking to do 3 option contracts, in this case, you would multiply by that number by 3. It would be $22,200. Okay, so that is how you go about calculating the capital requirements to go into the wheel strategy. So really a quick way to do it is just to kind of look at the stock price, multiply by 100, and just kind of gauge if you have the capital requirements to kind of go at that point in time, or if you want to go with more contracts. But really the more precise way is to look at the strike prices that you are looking to sell, and that would get you your capital requirements needed to start the wheel. Alrighty, take care, Alpha Hunters.